Welcome to the Deep Dive, your shortcut to being well-informed.
Great to be diving in again.
Today, we're plunging into a topic that underpins nearly every financial interaction: the intricate world of tax deduction, collection, and recovery. This isn't just about crunching numbers. It's about understanding the very arteries of our financial system and, let's be honest, saving ourselves some serious headaches down the line.
That's right. And for this particular deep dive, we've compiled a truly comprehensive set of materials, almost like an exam-oriented study guide.
Okay.
Our mission today is to distill every essential concept, every minor point, every nuanced detail, ensuring you gain a truly deep and applicable understanding.
Right.
Think of it as your ultimate shortcut to mastering these provisions, preparing you not just for knowledge, but for real-world application, right down to the most surprising facts and crucial compliance points.
Exactly. So whether you're gearing up for a critical business meeting, aiming to sharpen your financial literacy, or just intensely curious about how taxes are handled before they even hit your bank account, you are absolutely in the right place.
Yeah.
We'll be your guides through these complex provisions, highlighting practical implications and, those aha moments you perhaps didn't see coming.
Just a quick note before we jump in. While we'll be covering a broad spectrum of core provisions today, specific details related to, say, non-residents, REITs, invites, or certain trusts and institutions, well, those are typically discussed in dedicated chapters of direct tax laws.
Like non-resident taxation or assessment of trusts.
Precisely. Our focus today is squarely on the fundamental mechanics as presented in our source material, ensuring you get a solid foundation.
All right, let's kick off our main deep dive by understanding the very foundation of how income tax is recovered. It's a fascinating principle, really, because while your total income for, say, the financial year 2024-25 is technically taxable in the next assessment year, 2025-26, the government starts recovering that tax from you in the current previous year itself.
That's spot on.
It's all about ensuring a steady stream of revenue for the government, I suppose.
It absolutely is. This immediate recovery model is crucial for the stability of any modern financial system. The Income Tax Act uses, three primary modes to achieve this. First, tax deduction at source, commonly known as TDS.
Right, TDS.
Second, tax collection at source, or TCS.
PCS.
And third, the direct payment of advance tax by the SSE, the taxpayer themselves.
So if I understand correctly, TDS is when someone else, the payer, takes out your tax before they even hand you the money, like with salaries or interest payments.
Exactly.
TCS is a bit different, where a seller collects tax from a buyer at the point of sale for specific goods.
Correct.
And advance tax, that's you, the taxpayer, directly sending in your estimated tax payments throughout the year. But wait, there's actually a fourth, less common but important mode too, isn't there?
You're absolutely right. There's an additional mode of recovery. Tax paid by the employer under Section 192 1A on non-monetary perquisites provided to an employee.
Like benefits that aren't cash.
Exactly. Think of things like a company car or an apartment provided by your employer. The employer has the option to pay the tax on these perquisites directly.
Okay.
And here's the key bit. That payment by the employer is not treated as an additional perquisite in the employee's hands.
Really? So no double tax?
Right. It means the employee doesn't get taxed again on the tax that the employer pays on their behalf for these non-cash benefits. That can be a significant cash flow advantage for the employee.
That's a neat trick. And all these collected or paid amounts, TDS, TCS, employer-paid perquisite tax, and advance tax, they don't just vanish.
No.
And they're all adjustable against your total tax due when you finally file your income tax return, right?
Precisely. This adjustment mechanism is designed to ensure that you only pay your final net tax liability. Now, historically, there was a significant challenge in recovery proceedings. If tax was supposed to be deducted at source but wasn't, well, the recovery actions had to be taken against the SSE whose tax was liable.
Right, the employee or recipient.
Which could be quite cumbersome for the tax authorities,
That sounds like a potential loophole for some deductors to slip through. So how did the law address that?
To overcome this, an explanation was added to Section 190. It clarifies that the person required to deduct tax at source.
The payer.
Yes, and this explicitly includes the principal officer of a company or an employer paying tax on non-monetary perquisites under Section 192.12.1a. They become directly liable for the recovery.
So the onus shifts.
Exactly. It shifts the onus squarely onto the deductor. It's a fundamental change that ensures someone is always on the hook for the tax that should have been withheld, streamlining the recovery process for the government.
That's a critical clarification, putting the responsibility right where it needs to be. Now let's talk about a very specific and interesting provision related to eligible startups under Section 80 IAC.
Okay.
Imagine an eligible startup allotting or transferring specified securities or sweat equity shares to an employee at no cost or a concessional rate. This is clearly a perquisite.
Mm-hmm.
So when does the tax on that perquisite come due? It sounds like it could be a heavy burden if taxed immediately.
This is indeed a significant relief for employees in eligible startups, unlike most perquisites where tax is typically due almost immediately.
Yeah.
For these specified securities or sweat equity shares, the income tax on such perquisite income must be paid by the employee within 14 days from the earliest of 3 very specific dates.
Okay, what are those dates?
Right. The first is the expiry of 48 months from the end of the relevant assessment year. The second is the actual date of sale of such security or share by the employee. And the third is the date the employee ceases to be an employee of that allotting or transferring employer.
So whichever happens first.
Whichever happens first. This deferral is designed to help employees avoid immediate liquidity issues, you see. They only have to pay tax when they potentially gain cash from selling the shares or when their employment with the startup ends. It aligns the tax burden with a potential liquidity event, ##2. Diving deep into tax deduction at source, TDS, sections 192 to 206 AB.
With those core mechanisms laid out, let's dive deep into tax deduction at source, or TDS. This is where a huge number of our daily financial transactions get impacted.
Absolute.
From your salary to bank interest. We're going to break this down section by section, starting with Section 192, which covers salaries.
Okay, so under Section 192, every person responsible for paying any income chargeable under the salaries head is legally obligated to deduct tax.
Your employer, basically.
Your employer, yes. It's not an option. It's a statutory duty.
And speaking of employers, the tax regime choices, whether an employee sticks with the new default regime or opts for the old one, directly impact how the employer deducts tax, don't they? This seems to be a point of confusion for many people.
Absolutely it is. The employer deducts tax based on whether the employee formally intimates their choice to opt out of the default tax regime.
So the employee has to tell them.
Yes. If no intimation is made, the employer presumes the employee continues in the default tax regime and deducts tax according to the rates in Section 115BAC1A. Now, here's a crucial point.
Okay.
This intimation given to your employer for TDS purposes does not amount to actually exercising the final option under Section 115BA6 for income tax filing.
All right. That's a separate step.
That requires separate formal action when you file your return. So the employer's TDS action is just a provisional step, until you make your final choice for filing.
That distinction is really important. So the employer's TDS is just a placeholder until your final tax filing. What about those non-monetary perquisites we mentioned earlier, like a company-provided car? How is tax handled on those non-cash benefits?
Well, tax is indeed deductible on the value of non-monetary perquisites. However, the employer has a beneficial option. They can choose to pay this tax themselves.
Oh.
And importantly, this payment by the employer is not treated as an additional perquisite in the employee's hands.
That's a good deal for the employee.
It is. It means the employee doesn't get taxed on the tax that the employer pays on their behalf for these non-cash benefits, which is a significant relief.
That's a great relief. And for those eligible startups and their perquisite shares we just talked about, is there a consistent time limit for the employer to handle the tax on those?
Yes, consistency is key here. An employer who is an eligible startup paying income as a perquisite, those specified securities or sweat equity shares must deduct or pay tax on the value of such perquisite within 14 days from the earliest of those 3 dates we discussed under Section 190.
The 48 months, sale date, or leaving the job.
Exactly. The expiry of 48 months from the end of the assessment year, the actual sale date, or the cessation of employment, it directly ties back to the same principle of deferring the tax burden until a liquidity event.
That makes perfect sense. Now, what if you're, like many people, constantly moving between jobs or even juggling multiple employers simultaneously? How does my current employer figure out how much tax to deduct, taking into account all my income?
Right, good question. In such cases, an employee can forward details of income and TDS from their previous or concurrent employers to their current employer.
So you provide Form 12B, for example.
Precisely, or similar details. The subsequent employer must then consider all this information, your total income from all sources, and the tax already deducted and deduct the remaining tax payable on the employee's combined remuneration for the entire financial year. This ensures that the total TDS across all employers matches your actual tax liability for the year as closely as possible.
And for those earning salaries in foreign currency, how's that converted for tax purposes? It can't be left to individual discretion, I imagine.
You're right, it can't. The value of salaries paid in foreign currency must be calculated in rupees at the prescribed exchange rate, which is specifically laid out in Rule 26 of the Income Tax Rules, 1962. This brings uniformity and certainty to the conversion.
What about government employees or those in specified institutions like companies, cooperative societies, or universities? Are they treated differently for TDS on salaries?
Generally, for employees of government or specified entities, tax is deducted as per Section 115 BAC 1A if no option to opt out of the default regime has been exercised.
So the default regime usually applies unless they opt out.
Correct. This essentially brings them under the umbrella of the default regime's provisions for TDS on salary.
Here's a practical update. Coming into effect from October 1st, 2024, regarding cash flow for employees. Section 192(1)B has been extended. How does this help prevent overdeduction and ease an employee's immediate tax burden?
This is a significant practical change, really aimed at alleviating cash flow issues for employees. Previously, employees could primarily inform their employer about loss from house property or maybe other salary-related TDS. Now, an employee can inform their employer about any other tax-deducted or collected at source, meaning any TDS or TCS from any other income that they've received during the year.
Oh, that's much broader.
It is. This allows the employer to take a more comprehensive view of the employee's total tax credits and make a more accurate adjustment of TDS on salary. It could potentially reduce the amount withheld from their paycheck if they have other tax credits already paid.
That's a smart move to prevent overdeduction.
Yeah.
But are there any strict restrictions on reducing the tax deducted at source on salaries? Can they reduce it for just anything?
No, there are specific limits. While other particulars, like other TDS, TCS, can be considered, the tax deducted at source on salaries should not be reduced except for two specific allowances.
Okay, what are they?
First, loss from house property, which is allowable up to a maximum of $2,000.
2 lakhs.
And second, any other tax already deducted at source, TDS, or tax collected at source, TCS, that the employee informs them about. Those are the only permissible reductions to the salary TDS calculation itself.
And employers have a duty to provide a detailed statement of perquisites, right? Form 12BA. Transparency is key here.
Absolutely. Under Section 192(2)(c), the employer must furnish Form number 12BA to the employee. This form provides correct and complete particulars of any perquisites or profits in lieu of salary, ensuring the employee has all the necessary information to accurately report their income and avoid discrepancies later.
This next point is critical for employers, and it leads into a really important case study we need to discuss. Section 192(2)(d) and Rule 26(c) mandate employers to obtain evidence or proof of claims, like exemptions. Why is this so vital for compliance, and what happens if an employer doesn't follow this?
This is a truly crucial compliance requirement. To avoid significant penalties for the employer, it's simply not enough for an employer to rely on an employee's self-declaration for things like leave travel concession or house rent allowance exemption.
You mean the receipts?
Essentially, yes. The law, specifically Rule 26(c), requires the salaried employee to furnish actual evidence of expenditure to the employer for these claims to be considered for TDS computation. Without this evidence, the employer cannot just assume the claim is valid for TDS purposes.
And we have an illustration that perfectly demonstrates this compliance requirement in action. The LL Limited case study. What happened there and what was the ruling?
Right. In this scenario, LL Limited paid leave travel concession to its employees, but unfortunately relied solely on the employees' self-declarations for exemption. They didn't verify any proof of actual expenditure.
Oops.
Yeah. The assessing officer, or AO, consequently treated LL Limited as an assessee in default for failing to deduct the proper amount of tax. When challenged, the AO's action was deemed correct in law.
Because of 192 and Rule 22D and Rule 26C.
Exactly. They clearly mandate obtaining evidence. Relying only on self-declaration, even if the employee chose to opt out of the new tax regime, is insufficient. This case highlights a critical compliance requirement for employers. You must demand and verify supporting documents for employee claims, or you risk being held responsible for underdeduction and facing penalties.
That's a sharp reminder for all employers out there. Moving on to another specific TDS section, Section 192A deals with premature withdrawals from employees' provident fund. or EPF. When does this become relevant for TDS?
This section applies when the accumulated balance from a recognized provident fund, or RPF, becomes taxable. This typically happens because Rule 8 of Part A of the Fourth Schedule doesn't apply.
Like leaving before 5 years.
For example, yes, if the withdrawal occurs before 5 years of continuous service without valid reasons like cessation of business, or if an employee chooses not to transfer their balance to a new employer upon changing jobs. In essence, it targets withdrawals that lose their tax-exempt status due to insufficient service period.
And what are the compliance concerns here, especially with Rules 9 and 10 of Part A, Fourth Schedule? It sounds a bit complicated to figure out the exact tax amount.
It can be, theoretically. Rule 9 states that the tax liability on a premature withdrawal is computed by effectively recomputing the tax for the years of contribution as if it were an unrecognized provident fund.
Wow, retrospectively.
Yes. And Rule 10 then places the responsibility on the trustees of the RPF to deduct this recomputed tax at the time of payment. The practical difficulty, however, lies in that while private provident fund trustees often have access to necessary year-wise taxable income details for accurate Rule 9 computation.
They have the data.
Right. Trustees of the Employees Provident Fund Scheme, or EPFS, might struggle to get such detailed historical information, making precise calculation under Rule 9 difficult in practice.
So what's the straightforward mechanism for TDS in such cases? To simplify things, is there a flat rate?
Despite those complexities in precise recomputation, Section 192A mandates a straightforward TDS rate of 10% on such premature taxable withdrawals. This tax is deducted at the time of payment of the accumulated balance.
Is there a threshold for this? Like, if it's a very small amount, do they still deduct?
Yes, there's a threshold. No TDS is required under this section if the payment amount or the aggregate payment to the payee is less than $50,000.
$50,000.
Correct. It's designed to avoid burdening very small taxable withdrawals with TDS procedures.
Let's quickly look at an example. Mr. Sharma. He resigned after less than 5 years of service and withdrew $60,000 from his EPF.
Right.
What happens here?
Okay. Since Mr. Sharma resigned after less than 5 years of continuous service, Rule 8 does not apply, making the entire $60,000 withdrawal taxable.
Right.
The amount exceeds the $50,000 threshold.
Really?
So TDS applies. The calculation would be 10% of $60,000, which is $6,000. So Mr. Sharma would receive a net amount of $54,000 after the TDS. This clearly illustrates the direct application of the 10% rate once the threshold is crossed.
Moving on to Section 193. Interest on securities. Who is responsible for deducting tax here, and what's the rate?
Any person paying income from interest on securities to a resident is responsible for deducting tax. The rate of TDS is a straightforward 10%.
10%.
Yes, applicable for both domestic companies and resident non-corporate assessees. Tax is deducted at the earlier of when the income is credited to the payee's account or when the payment is actually made cash, check, draft, whatever mode.
And the deemed credit rule applies here too, right?
What?
So if I credit it to an interest payable account or suspense account, it's still considered credited for TDS purposes.
Precisely. If interest is credited to any such account in the books of the payer, it's immediately deemed a credit to the payee's account for TDS purposes. This means the obligation to deduct tax arises at that very point, even if the actual cash hasn't left the payer's hands yet.
Now, this section has an extensive list of non-applicability cases, which are absolutely crucial for an exam-oriented understanding, as they represent specific exemptions from TDS. Can you walk us through some of the key exemptions where no TDS is required for interest on securities?
This list is indeed critical for precision and for avoiding common pitfalls. No TDS is required on interest payable on, well, quite a few things. 4.25% national defense bonds, 1972, but only if held by an individual who is not a non-resident. 4.25% national defense loan, 1968, or 4.75% national defense loan, 1972, specifically if payable to an individual. National development bonds. 7-year national savings certificates by the issue.
Okay, those are older ones. What about more current examples?
Right. Also, debentures issued by certain institutions, authorities, public sector companies, or cooperative societies as notified by the central government. For example, Power Finance Corporation Limited 54 EC Capital Gains Bond, PFCL, and Indian Railway Finance Corporation Limited 54 EC Capital Gains Bond, IRFCL, have been notified.
Ah, the 54 EC bonds.
Exactly. And there's a key condition for transferred bonds to get this exemption. The transferee must inform PFCL or IRFCL by registered post within 60 days of the transfer.
Good to know.
Any others? Yes. Also, 6.5% gold bonds, 1977, or 7% gold bonds, 1980, again, if held by an individual, not a non-resident, provided they furnish a written declaration stating that the nominal value of bonds held is less than $10,000 at any time during the interest period.
10,000 limit.
Correct. And perhaps most importantly, any security of the central government or a state government.
Generally no TDS on golden securities.
Generally, no. However, it's important to note that TDS is applicable if interest on central or state gold securities is paid to a resident by way of interest on compensation for compulsory acquisition of immovable property.
Okay, specific exception there.
Yes. Also exempt is interest payable by an infrastructure debt fund to a non-resident and interest payable to a business trust by a special purpose vehicle on any security. This comprehensive list covers a wide range of specific financial instruments that enjoy this TDS exemption.
That's quite a list, reinforcing how specific these exemptions can be. Knowing these exceptions is vital. Let's move to Section 194, covering dividends. Who needs to deduct tax here?
The principal officer of a domestic company is obligated to deduct tax on dividends distributed or paid to resident shareholders.
And no rates.
The standard rate of TDS for dividends is 10%.
Is there any specific exemption for dividends, perhaps for special financial zones like the IFSC?
Yes. There is a specific exemption under Notification Number 522023, dated July 20th, 2023. No TDS is required under Section 194 on dividends paid by any unit of an International Financial Services Center, or IFSC, which is primarily engaged in aircraft leasing.
Okay, aircraft leasing.
To a company that is also an IFSC unit primarily engaged in aircraft leasing. This is subject to the payee furnishing a verified statement cum declaration to the payer about the dividend income being eligible for exemption under Section 1034B. This clearly highlights special tax incentives designed to promote specific activities within IFSC units.
All right, on to Section 194A. Interest other than interest on securities. This is a very broad and impactful section affecting everything from bank deposits to various other interest payments. Who is obligated to deduct tax here?
Any person responsible for paying interest other than interest on securities to a resident. However, there's a significant carve-out. Individuals or Hindu undivided families, HUFs.
Right.
They are not liable to deduct tax under this section unless their total sales, gross receipts, or turnover from business or profession in the immediately preceding financial year exceeded 1 crore for business or 50 lakhs for profession.
The audit threshold, essentially.
Correct. This provides a clear turnover threshold for smaller businesses and individuals.
And what's the general rate of TDS and the timing for these interest payments?
The general rate is 10%. Tax is deducted at the earlier of when the income is credited to the payee's account or when the payment is actually made in cash, by check, draft, or any other mode. And consistent with other sections, the deemed credit rule applies here as well.
The suspense account thing again.
Exactly. Crediting interest to accounts like interest payable account or suspense account is considered a credit to the payee's account, triggering the TDS obligation.
Now, this section also has very detailed thresholds for non-applicability, which are highly important for practical application and exams. Can you break those down for us?
Certainly. There's a general de minimis threshold. No TDS if the aggregate interest paid or credited during the financial year does not exceed $5,000.
$5,000.
However, for specific payers, there are significantly higher thresholds. The threshold is $40,000, where the payer is a banking company, a cooperative society engaged in banking business, or a post office, and the interest is on deposits under notified scheme.
$40,000 for banks, co-op banks, post offices.
Right. For example, the Senior Citizens Savings Scheme 2019 and the Mahila Salmon Savings Certificate 2023 have been notified for this purpose. The Mahila Salmon Savings Certificate, that one-time scheme running from April 1st, 2023 to March 31st, 2025, offering up to 2 lakh deposit for women girls at 7.5% PAA, generally won't generate interest exceeding $40,000, so no TDS typically applies to it.
And even higher for seniors.
Yes, even higher. The limit is $50,000 if the payee is a senior citizen, age 60 or above, and the payer is one of those entities, the banking company, co-op society, or post office mentioned above.
That's quite a range of thresholds designed to reduce compliance burden for smaller amounts and for senior citizens.
Yeah.
And what about banks that have adopted core banking solutions, or CBS? How does that impact the calculation of these thresholds? This is a crucial practical point.
This is a critical point for practical application, absolutely. If a banking company, cooperative society, or public company has adopted CBS, the threshold is calculated with respect to income credited or paid by the entire entity across all its branches.
Not branch by branch.
Not branch by branch. This means all deposits held by a single PAN across all branches are aggregated to check if the $40,000 or $50,000 threshold is crossed.
Are there other general cases where 194A simply doesn't apply, regardless of amount.
Yes, quite a few. It does not apply to interest paid or credited by a firm to any of its partners.
Because they're taxed on profits anyway.
Correct. Also, interest on deposits under central government schemes specifically notified for this purpose. Interest income on deposits, other than time deposits made on or after July 1st, 1995, with a banking company regulated by the Banking Regulation Act, 1949. Income paid or credited by a cooperative society, other than a cooperative bank, to a member or another cooperative society.
Okay.
Interest income on deposits with specific types of cooperative entities like primary agricultural credit societies, primary credit societies, cooperative land mortgage banks or land development banks, also a banking company or a bank engaged in banking business. Interest income credited or paid by the central government under any provisions of the Income Tax Act, 1961.
Like tax refunds.
Exactly. Interest paid or credited to certain specified entities, such as banking companies themselves, cooperative societies engaged in banking, financial corporations, LIC, UTI, and notified institutions like the National Skill Development Fund and HUD-EDO. And finally, interest on compensation awarded by the Motor Accidents Claims Tribunal. This comprehensive list details specific scenarios where the TDS obligation is lifted.
Wow, that's incredibly detailed. This is where the exam-oriented aspect truly shines. We also have some crucial special circulars and clarifications for Section 194A that delve into specific, complex scenarios. Let's start with the intriguing case of interest on fixed deposits held in the name of the Registrar General of a court.
Right. This is a complex scenario with a clear legal resolution. Historically, there was ambiguity about who was the payee for TDS purposes. However, the Honorable Delhi High Court in the UCO Bank case ruled that Section 194A does not apply to fixed deposits made in the name of the Registrar General on court directions during the pendency of proceedings.
Why not?
Because the actual beneficiary is unknown and the amount or year of receipt is unascertainable until the court makes a final decision.
And the CBDT accepted this judgment, which is always a good sign for consistency.
Yes, the CBDT accepted this judgment. So interest on such FDRs is not subject to TDS until the court ultimately decides ownership. Once ownership is decided, however, Section 194A provisions will apply to the recipient of the income. This prevents unnecessary TDS in cases of uncertain or disputed ownership.
What about payments to members of a scheduled tribe under Section 1026 by a scheduled bank? Any special rules there?
Yes, under Notification Number 110-2021, no TDS is required under a 94A on interest, other than interest on securities, paid by a scheduled bank in a specified area to a scheduled tribe member residing in a specified area as per Section 1026.
Conditions apply, I assume.
Yes. This exemption comes with conditions. The payer must satisfy themselves of the receiver's status, often by obtaining documentary evidence, report the payment in their TDS statements, and importantly, ensure the aggregate payment does not exceed 20 lakh.
20 lakhs. And a very specific situation. Interest income accrued to a minor child where both parents are deceased. How is TDS handled in such a sensitive case?
For deposits under the capital gains account scheme, 1988, if the depositor is deceased, the TDS on interest accrued up to the period of death is deducted and reported against the depositor's PAN.
Oh, yeah.
However, TDS on interest accrued after the death is deducted and reported against the legal heir's PAN. This provides clarity on how to handle TDS in such sensitive cases, ensuring correct attribution. This is unless a declaration is filed under Rule 37BA2 for credit to another person.
Let's quickly go through Illustration 3, applying these 194A thresholds as these examples really bring the rules to life. First, Mr. Harish, 45 years old, has a 10 lakh fixed deposit at 9% with ABC Cooperative Bank for 6 months. What's the TDS implication?
Okay. The interest calculates to $45,000. 10,000, 9%, 612. Since it's a cooperative bank and Mr. Harish is not a senior citizen, the higher threshold for these entities is $40,000.
Right.
As $45,000 exceeds $40,000, TDS at 10% applies, resulting in $4,500 being deducted.
Next, Mr. Ganesh, 35 years old, has three 3 lakh FDs at 9% with 3 different branches of XYZ Bank, which has adopted Core Banking Solutions, CBS.
Here, because XYZ Bank has adopted CBS, the aggregate interest across all branches must be considered.
Total interest.
Yes, the total interest from all 3 FDs is $60,750, assuming 9 months for calculation. 3,000, 9%, 912. As this aggregate of $60,750 exceeds the $40,000 threshold, TDS at 10% applies on the entire $60,750. This is a common pitfall where branches might not communicate without CBS.
Finally, Mr. Rajesh, 40 years old, has a $2,008 per month recurring deposit at 8% with PQR Bank for 6 months.
The interest from this recurring deposit comes out to $28,000 based on RD interest calculation. This amount is below the $40,000 threshold for banking companies. Therefore, no TDS is required under Section 194A. These examples really solidify the threshold rules and the critical impact of CBS.
Speaking of CBS, illustration 4 brings up a common pitfall that banks can face. Maya Bank and the suspense account issue? What happened here and what was the tax authority's stance?
Right. In this scenario, Maya Bank credited $73,050,000 in interest to a separate account for macro monitoring using its CBS, but it didn't deduct tax where interest for some depositors individually exceeded $40,000.
Okay.
The assessing officer, or AO, consequently disallowed 30% of the interest expenditure claimed by the bank and levied a penalty under Section 271C, arguing that the bank failed to deduct tax.
Was the AO's action correct in law? Was that suspense account argument valid?
No, the AO's action was ultimately not valid. The explanation to Section 194A explicitly states that crediting interest to any account, even a suspense account, or a macro monitoring account, as in this case in the books of the payer, is deemed a credit to the payee's account.
Triggers TDS.
Exactly. This means the obligation to deduct TDS arises at that point, regardless of the internal accounting label. Therefore, the disallowance and penalty were not tenable in law, reinforcing the deemed credit principle as a critical point for compliance. Banks must deduct TDS when the entry is made in their books, even if it's not directly credited to the customer's individual account immediately.
This deemed credit principle is clearly a critical point for compliance. Let's briefly touch on winnings from lotteries, crossword puzzles, and horse races, covered under Sections 194B and 194BB. What are the key takeaways here?
These are fairly straightforward, really. For winnings from lotteries, crossword puzzles, card games, or other similar games under Section 194B, the rate of tax deduction is 30%.
30%.
Yes, if the winnings exceed $10,000. Similarly, for winnings from horse races under Section 194BB, the obligation to deduct also arises when the payment of winnings from any horse race exceeds $10,000 in aggregate in the financial year, and the rate is also 30%. These sections have clear rates and thresholds, focusing on high-value speculative incomes.
Now, a very new and important section. Winnings from online games, Section 194BA, which came into effect on July 1st, 2023. This is a game changer for digital transactions and a sector that has grown exponentially. Who is applicable and what's the rate?
Any person responsible for paying income by way of winnings from any online game is applicable. The prescribed rate of tax deduction for these winnings is 30%.
30% again. And when is the tax deducted? This sounds complex, with potential multiple withdrawals and balances.
It is indeed quite nuanced. Tax is generally deducted on net winnings computed at the end of the financial year.
Okay, end of year.
However, if there's a withdrawal from the user account during the financial year, income tax is deducted at the time of such withdrawal. This deduction applies to the net winnings comprised in that withdrawal, as well as on any remaining amount of net winnings in the user account that haven't been taxed yet. This ensures a continuous flow of tax collection as winnings are realized or withdrawn.
So how are net winnings actually calculated for an online game according to the specific formula in Rule 133? This is crucial for determining the taxable amount.
The formula for net winnings, as per Rule 133, is simply A minus the sum of B and C. So A, B plus C.
Okay, what are A, B, and C?
A represents the total amount withdrawn from the user account during the period. B is the aggregate amount of non-taxable deposit made in the user account by the owner during the financial year, up to the time of withdrawal. And C is the opening balance of the user account at the beginning of the financial year.
Right.
Importantly, if the sum of B, non-taxable deposits, and C, opening balance, is equal to or greater than A, the withdrawal, the net winnings are considered zero, meaning no tax is due on that particular withdrawal. There are also specific rules for subsequent withdrawals during the year to properly account for previous deductions and balances.
What exactly do non-taxable deposit and taxable deposit mean in this context? These terms are key to applying the formula.
Okay. A non-taxable deposit is an amount deposited by the user that is not taxable in their hands, meaning it's money from already taxed income or funds that are simply not chargeable to tax.
Like your salary deposit.
Exactly. A taxable deposit, conversely, is any amount deposited that's not non-taxable. And this includes any amount paid directly to the user outside their online user account, like maybe a bonus paid separately. Withdrawal simply means any amount the user takes out from any user account they hold with the online game deductor. And the term user account includes every account of a user registered with that online game deductor, ensuring comprehensive coverage.
The CBDT has issued some important Q&As on this new section to clarify common practical scenarios. Let's go through them. First, what if a user has multiple user accounts with the same deductor? Do they aggregate across accounts?
Yes, generally. For calculation purposes, deposits, withdrawals, and balances across all user accounts held by a single user under that deductor, meaning 110LN, are aggregated. This prevents users from splitting their income across accounts to avoid TDS thresholds.
But there's an exception.
Yes, there's a practical exception. If it's not technologically feasible to integrate multiple user accounts across different platforms operated by a single deductor, then the deductor may calculate tax for each platform separately. Even in this case, though, all user accounts under one user on that specific platform must still be aggregated.
What if the user borrows money and deposits it into their online game account? Is that considered a taxable or non-taxable deposit?
If a user borrows money and deposits it, it's considered a taxable deposit for the purpose of this section, unless it can be explicitly shown that the borrowed funds are from already taxed income or are inherently not chargeable to tax. This means such deposits could increase the potential net winnings calculation.
And what if the winnings aren't cash, but things like coupons or items in kind? How is that handled for TDS?
If goods, services, or items in kind are issued instead of cash winnings, it's still treated as a withdrawal for TDS purposes. The deductor must ensure tax is deducted before issuing such items. The clarification regarding aggregation across multiple user accounts also applies here, ensuring consistency.
There's a practical difficulty for very small withdrawals. Is there any concession for that to avoid deducting tiny amounts of tax frequently?
Yes. To remove this practical difficulty, tax may not be deducted if all these conditions are met. First, the net winnings in the withdrawn amount do not exceed 100 in a month.
Okay, 100 rupees.
Second, any tax not deducted due to this concession is deducted later specifically when net winnings exceed 100 in the same or a subsequent month, or at year-end if no further withdrawal occurs. And third, the deductor undertakes responsibility for paying the difference if the user account balance becomes insufficient for TDS at a later point. This provides practical relief for minor transactions without losing the tax eventually.
How is the valuation of these in-kind winnings handled for deduction purposes? Is it based on what the company paid or what it's worth?
It depends. If money in the user account is used by the deductor to buy an item and that item is then given to the user, it's simply treated as cash winnings, and the deductor deducts tax from the cash equivalent. However, if an item in kind is given directly to the user, like a car as a prize, the valuation for TDS is based on its fair market value, or FMV. Specifically, if the provider purchased the item, they use the purchase price for valuation. If the provider manufactured the item, they use the price they charge to their own customers for such items. This ensures a consistent and fair valuation method.
This is a very detailed news section, crucial for anyone involved in online gaming platforms or digital transactions. It really shows how tax laws are adapting to new business models.
Absolutely. It's a rapidly evolving area.
Let's shift gears now to Section 194C, which covers payments to contractors and subcontractors. This is a huge part of business operations for so many sectors. Who is applicable here?
Right. Any person responsible for paying sums to a resident contractor for carrying out any work is obligated to deduct tax. This includes a wide range of entities: central state governments, local authorities, statutory corporations, companies, cooperative societies, statutory housing authorities, registered societies, trusts, universities, firms, foreign governments, enterprises.
A big list.
And crucially, certain individuals, or HUFs, if their total sales, gross receipts, or turnover from business or profession in the immediately preceding financial year exceeded 1 crore for business or 50 lakhs for profession.
What are the rates for TDS, and when exactly is it deducted for these payments?
The rates are 1% if the payee is an individual or Hindu undivided family, and 2% if the payee is any other person, like a company or firm.
1% or 2%?
Correct. Tax is deducted at the earlier of when the sum is credited to the contractor's account or when payment is actually made in cash, check, draft, or any other mode. Consistent with other sections, the deemed credit rule for suspense accounts or similar entries also applies here.
Are there any specific thresholds or exclusions where 194C doesn't apply? This is important for smaller contracts.
Yes, there are important thresholds. Payments made by individuals or HUFs exclusively for personal purposes are exempt.
Personal use.
Also, no TDS is required if the value of a single contract payment does not exceed $30,000. And critically, no TDS is required if the aggregate of payments to a contractor during the financial year does not exceed 1,000.
30,000 single, 1 lakh aggregate.
Exactly. So even if individual payments are below 30,000, if their total for the year crosses 1,000,000, TDS applies.
And there's a specific exemption for transporters, isn't there, for payments to them?
Correct. As clarified by Circular Number 19/2015, no TDS is required if the payment is made to a contractor who owns 10 or fewer goods carriages at any time during the previous year.
10 trucks or less.
Right. This is contingent on the contractor furnishing a declaration to that effect along with their PAN. A goods carriage means any motor vehicle constructed or adapted solely for goods, or any motor vehicle used for goods, excluding very small vehicles, real vehicles, or those used only within factories.
Is there a catch?
Yes, a crucial caveat is that transportation charges paid to a third-party transporter of gas by an owner, seller, or purchaser remain governed by other appropriate Act provisions and are subject to TDS at applicable rates. So this specific exemption for transporters doesn't apply to gas transportation.
The definition of work under 194C is absolutely critical here for determining if the section applies. What exactly does it cover, and what's the most important exclusion that often causes confusion?
This definition is indeed central and often misunderstood. Work includes several categories: advertising, broadcasting and telecasting, including the production of programs for telecasting, carriage of goods or passengers by any mode of transport other than railways, catering, and crucially, manufacturing or supplying a product according to a customer's requirement or specification using material purchased from such customer or its associate.
Okay, using the customer's material.
Exactly. Now, here's the crucial exclusion you asked about. Work does not include manufacturing or supplying a product according to customer specifications if the raw material is purchased from a person other than the customer or their associate.
So if the supplier uses their own materials.
Right. Such a contract is considered a contract for sale and not a work contract for 194C purposes, regardless of any printing or processing expenditure involved. This distinction is vital. However, this exclusion does not apply to contracts that don't entail manufacture or supply of an article or thing, like a pure construction contract.
That material source distinction is a game changer for many manufacturing and supply contracts. Let's look at some other important clarifications. Payments by broadcasters to production houses for content, for instance. How is that viewed under 194C?
Okay. Under Circular No. 042016, TDS under 194C applies to payments for producing content or programs, as this involves carrying out work.
Making something new.
Yes. However, if the payment is for licensing or purchasing existing content that has already been produced by the production house, there's no ongoing carrying out any work on behalf of the broadcaster. In such cases, Section 194C does not apply.
What about the GST component in payments to contractors? Is TDS on the full amount, including GST?
No. If the GST component on services is indicated separately in the agreement or contract, tax is deducted on the amount without including the GST component. This principle avoids deducting tax on the tax itself.
A landmark case involves transporters hiring vehicles. Shri Chowdhury Transport Khana, VITO, before the Supreme Court. What was the core issue, and what was the Supreme Court's definitive ruling here regarding subcontractors?
In this case, an assessee firm was contracted to transport cement, but it lacked its own vehicle, so it engaged other transporters, truck operators owners, to fulfill the contract. The cement company deducted TDS from payments to the assessee, but the assessee did not deduct TDS from the payments it made to the truck operators. The Supreme Court viewed the assessee as responsible for the entire transportation work. Hiring other transporters constituted a distinct contract between the assessee and those transporters, effectively making them subcontractors.
Subcontract.
Yes. Since there was no privity of contract between the cement company and the truck operators, the Supreme Court concluded that Section 194C was applicable, and the assessee was obligated to deduct tax from payments to the truck operators owners. This is a key case for understanding subcontracting liability, even in informal arrangements.
That's a huge clarification for logistics businesses, emphasizing responsibility down the chain. Let's use illustration 7. Harathi Cements Ltd. purchasing jute bags with its logo from Raj Kumar & Co. Raj Kumar & Co. manufactured these bags using raw materials they purchased from outsiders. Harathi Cements did not sell any material to Raj Kumar. Is 194C attracted, and does TDS apply?
Based on the crucial definition of work under 194C, since Raj Kumar and Co. used its own raw materials, purchased from outsiders, not from the customer or its associate, this transaction is considered a contract of sale,
Not work.
not a work contract for 194C purposes. Therefore, Section 194C is not attracted, and no TDS liability arises for Varathy Cements Ltd. This vividly illustrates the raw material source distinction.
In illustration 8, Alap Ltd. made 5 payments to Vilambit Ltd. for different contracts in a financial year. Each individual payment was less than $30,000, but the aggregate sum of all 5 payments, $1,002,000, exceeded $1,000,000. Is Alap Ltd. correct in claiming no TDS liability because each payment was small?
No, Alap Ltd. is incorrect. Section 194C5 explicitly states that TDS applies if a single payment exceeds $30,000 OR, if the aggregate of payments to a contractor during the financial year exceeds $1,000.
The aggregate threshold was crossed.
Exactly. Since their aggregate sum was $1,002,000, exceeding $1,000,000, tax is required to be deducted. The TDS would be applied on the whole amount of $1,002,000, and practically this deduction would be made from the last payment of $17,000, which caused the aggregate to cross the limit.
What if the last contract was $14,000 instead, bringing the aggregate to $99,000? Would TDS still be required?
In that specific case, since the aggregate would be $99,000, which is below the $1,000 aggregate limit, no TDS would be required under Section 194C. This example really highlights the importance of keeping track of both individual and aggregate thresholds for compliance.
Excellent. Now, a relatively straightforward one. Section 194D, Insurance Commission. What are the essentials here for someone paying commission to an insurance agent?
Any person responsible for paying income by way of commission to a resident for soliciting or procuring insurance business must deduct tax. The rate of TDS is 5%.
5%.
Yes. TDS applies if the commission or aggregate commission paid during a financial year exceeds $15,000. If it's below that threshold, no deduction is required. It's quite simple and straightforward.
And then there's Section 19040A, sum paid under life insurance policy. This is important because not all life insurance maturity proceeds are tax exempt. This section addresses those that are taxable.
Indeed. This applies to any sum paid to a resident under a life insurance policy which is not exempt under Section 10D. Essentially, it covers policies where the premium paid exceeds certain limits relative to the sum assured, making the maturity proceeds taxable.
Okay.
The tax is deductible on the amount of income comprised therein, meaning the sum received minus the aggregate insurance premium paid by the assessee up to the date of receipt.
And what's the rate of TDS here, and has it changed recently?
Yes, the rate has changed. For payments made before October 1st, 2024, the rate was 5%. For payments made on or after October 1st, 2024, the rate has been reduced to 2%.
Down to 2%.
Yes, a significant rate reduction for future payments.
Is there a threshold for this section, similar to other TDS provisions, so small maturity amounts aren't subject to TDS?
Yes, there is. TDS is required only if the payment or aggregate payment under a life insurance policy, including any bonus, in a financial year is $1,000 or more.
1 lakh or more.
Correct. This higher threshold aims to alleviate the compliance burden on smaller taxpayers and prevent unnecessary deductions for relatively minor maturity amounts.
Let's use illustration 9 to test the applicability of 194DA in 3 distinct scenarios. First, Mr. X receives 4.50 lakhs maturity for an LIC policy taken on July 1st, 2021, with a sum assured of 4 lakhs and annual premium of $75,000. What happens here?
Okay. Here, the annual premium of $75,000 exceeds 10% of the sum assured, $40,000 for a 4 lakh policy taken after March 31st, 2012.
So it's taxable.
Right. This means the policy is not exempt under Section 10D. The maturity proceeds of 4.50 lakhs exceed the 1,000 threshold for 194DA applicability. The income component subject to TDS is $4,050,000 proceeds minus $3,075,000. Total premium paid over 5 years is $75,000.
Okay.
Therefore, TDS is required at 5% as the payment date of June 30th, 2024 is before the rate change on the $75,000.
Next, Mr. Y receives 3.95 lakhs maturity with an annual premium less than 20% of the sum assured for a policy taken before April 1st, 2012.
This policy falls under the old rules, pre-April 1st, 2012, where the premium limit for exemption was 20% of the sum assured. Since his premium was less than 20%.
It's exempt.
It's therefore exempt under Section 1010D. As such, no TDS is required under Section 194DA.
Finally, Mr. Z receives $95,000 maturity with an annual premium exceeding 10% for a policy taken after March 31st, 2012.
Okay, so even though this policy is not exempt under Section 10D due to the premium condition.
That's taxable income.
Right. However, the maturity proceeds of $95,000 are less than the $1,000 threshold for 194DA applicability.
Below the limit.
Correct. Therefore, despite being a taxable policy, no TDS is required under Section 194DA because the amount is below the collection threshold. These examples thoroughly cover when 194DA is triggered and when it isn't.
That was comprehensive. Moving on to Section 194E, payments in respect of deposits under National Savings Scheme, etc. Quick overview.
This is fairly simple. The rate of TDS is 10% on payments made from a National Savings Scheme account. The tax is deducted at the time of payment. Yes, no deduction if the amount or aggregate payments in a financial year are less than $2,500.
$2,500.
Correct. Importantly, these provisions do not apply to payments made to the heirs of the assessee. This is a specific provision for a defined financial instrument.
In Section 194G, commission, etc., on the sale of lottery tickets.
Similar to other commission sections, any person paying commission, remuneration, or prize on the sale of lottery tickets must deduct tax. The rate is 5%.
Threshold.
No deduction is required if the amount or aggregate payment does not exceed $15,000.
$15,000, okay. Let's look at Section 194H, commission or brokerage. This one has some crucial distinctions, especially for how agency is defined, who is applicable.
Right. Any person responsible for paying commission or brokerage to a resident must deduct tax. There's an important exception. Individuals or HUFs are not liable to deduct tax unless their total sales, gross receipts, or turnover from business or profession in the immediately preceding financial year exceeded 1 crore for business or 50 lakhs for profession.
The audit turnover limits again.
Exactly. The rate of TDS is 5%. Tax is deducted at the earlier of when the income is credited to the payee's account or when the payment is made in cash, by check, draft, or any other mode.
Are there important exclusions for 194H where TDS doesn't apply?
Yes, quite a few crucial ones. No TDS is required if the aggregate payment in a financial year does not exceed $15,000.
$15,000 again.
Yes. It also explicitly excludes commission or brokerage payments already subject to TDS under Sections 194D, Insurance Commission. Crucially, it excludes transactions by stockbrokers on stock exchanges, as these don't involve an agency relationship for commission. They are typically considered principal-to-principal trades. And as per Section 197A, 1A, and 1B, individuals, HUFs, whose turnover is below the specified limits are not liable to deduct tax at source under this section, reinforcing the initial exclusion.
The CBDT has issued some key clarifications, particularly concerning the advertising business, which often involves complex relationships. This clarifies an older circular, doesn't it?
Indeed. Circular No. 052076 provided important clarity. It stated that payments from a client to an advertising agency are subject to TDS under Section 194C as a work contract.
Okay.
However, payments from an advertising agency to a television channel or newspaper company attract no TDS under Section 194C. What was further clarified, and is often a point of contention, is that fees or charges retained by advertising companies for media for canvassing or booking advertisements, often around 15%, are not subject to TDS under Section 194H.
So the agency's cut from the media house.
Right. The CBDT clarified that the commission mentioned in an older circular referred to payments for engaging models, artists, etc., not for booking advertisements by media companies, as the relationship between media and advertising agencies is often principal to principal.
But then the Supreme Court weighed in on this very issue in Prasarpathy and Adon v. CIT. What was their conclusion, and how did it differ from the general CBDT circular?
In the Prasarpathy case, the Supreme Court had a different view based on the specific facts. Deduction had entered into agreements with accredited agencies who retain a 15% commission. The court found that the specific agreement appointed these agencies as agents and explicitly had a clause for TDS on what was termed trade discount, but was effectively commission.
So the contract established agency.
Precisely. Thus, the relationship was indeed principal and agent, and Section 194H TDS was attracted to these retentions. The Supreme Court ruling overrides the general CBDT circular for specific factual situations where an agency relationship is clearly established by contract.
And a similar, equally important case that defined brokerage in a different context. ID Cellular Ltd. CIT before the Supreme Court. This involved telecom companies and discounts given to distributors on prepaid products. Was that discount considered commission or brokerage for 194H purposes?
This case provided crucial clarity on the principal-to-principal versus agency distinction. Telecom companies sold prepaid products to distributors at a discount, who then sold them on. Revenue argued this discount was commission under 194H.
Right.
However, the Supreme Court held that the relationship was principal to principal. The distributor bought the products outright, bore their own risk, and determined their own resale price. They were not acting on behalf of Idea Cellular.
Not an agent.
Exactly. Therefore, the discount was not commission under 194H. This case clarifies that Section 194H applies when there is an agency element, which wasn't present here.
That distinction is crucial for understanding when 194H truly applies. Let's move to Section 194II. Rent. This is another widely applicable section. Who is required to deduct tax here, and what are the rates?
Any person other than individuals or HUFs not subject to audit under Section 44AB responsible for paying any income by way of rent to a resident must deduct tax. The rates vary. 2% for rent of plant, machinery, or equipment.
2% for equipment.
And a higher 10% for rent of land, building, furniture, or fittings.
10% for property furniture.
Correct.
When is the tax deducted? And does the deemed credit rule apply here too?
Yes, the deemed credit rule applies. Tax is deducted at the earlier of when such income is credited to the payee's account or when the payment is actually made. If the sum is credited to a suspense account or similar temporary account, it's immediately deemed credited to the payee for TDS purposes.
Is there a threshold for rent payments? So smaller rental payments don't need TDS?
Yes, there is. No deduction is needed if the amount or aggregate income credited or paid, or likely to be credited or paid, during the financial year does not exceed $2,040,000.
$240,000 annual limit.
Right. If it crosses this amount, TDS applies.
And how precisely is rent defined for this section? It sounds broad.
Rent is broadly defined as any payment, by whatever name called, made under any lease, sublease, tenancy, or other agreement or arrangement for the use of land, building, land appurtenant to a building, machinery, plant, equipment, furniture, or fittings. This applies regardless of whether the payee actually owns the property or assets.
There are some very important circulars and case laws that further clarify the complex application of 194II. Let's start with cold storage cooling charges. Are these considered rent?
The CBDT clarified via Circular Number 1/2014 that cooling charges paid to cold storage owners are contractual in nature, representing a service for storage and preservation. Therefore, Section 194C, work contracts, applies to them, not Section 194I.
It's the service, not just space.
Precisely.
What about passenger service fees, PSF, paid by airlines to airport operators? Is that considered rent under 194I?
This was clarified by the Supreme Court in the Japan Airline to Singapore Airlines case. The court stated that the primary requirement for rent under 194I is payment for the use of land and building. Mere incidental use while providing other facilities or services wouldn't make it rent.
Right.
PSF are for a bundle of services,
Yeah.
air traffic control, safety, etc., not primarily for land use. Therefore, the Supreme Court concluded that Section 194I does not apply to PSF payments.
There are also specific exemptions for lease rent paid to IFSC units for aircraft or ship leasing aimed at promoting these specialized financial activities, aren't there?
Yes, under Notifications Num. 652022 and 572023. No TDS is required under Section 194I on such payments made by a lessee to a lessor who is an IFSC unit for aircraft or ship leasing. This exemption is conditional on the lessor furnishing a statement cum declaration and the lessee reporting details. It applies only for the assessment years for which the lessor opts for Section 80 LA deduction.
And the GST component of rental income, similar to 194C, is TDS on the full amount, including GST.
Correct. The CBDT has clarified that if the GST component is separately indicated, TDS under Section 194 should be made on the amount of rent excluding the GST component.
Okay, TDS on the base rent only.
Yes, if shown separately.
What about a lump sum lease premium paid for acquiring long-term leasehold rights? Is that considered rent under 194II?
No. The CBDT, in Circular Number 352016, clarified that lump sum lease premium or one-time upfront lease charges paid for acquiring long-term leasehold rights are not rent if they are not adjustable against periodic rent. They are for acquiring a capital right, so generally not liable for TDS under 194I.
We've got a case involving telecom towers. Indus Towers, LTBV, CIT. Yeah. Is payment for passive infrastructure, like sharing a telecom tower, considered rent? And if so, under which part of 194I?
Yes. The Delhi High Court ruled that payments for the use of passive telecom infrastructure are subject to TDS under Section 194I, not 194C. The dominant intention was deemed the use of equipment, plant, or machinery. Therefore, tax was deductible at 2% under Section 194IA.
The rate for plant machinery, and a very practical point from CITV Senior Manager SBI, regarding co-owned property. If a property is jointly owned, how does the $2,040,000 threshold under 194 apply for each co-owner? Is it to the total rent or each co-owner's share?
The Allahabad High Court held that for a co-owned property where each co-owner's share is definite and ascertainable, the $2,040,000 threshold applies to each co-owner separately.
Not the total rent.
Correct, not the total rent received from the property. This is because co-owners are generally assessed individually.
Let's apply this to illustration 11. ABC Ltd. took a building on sublease from J for $20,000 a month from September 2024 and hired machinery from J for $15,000 a month from November 1, 2024. Both credited on March 31st, 2025, using the sources solution figures.
Okay. Using the specific figures provided in the sources solution for illustration 11, the total aggregate rent for the financial year amounts to $2,065,000. This comprises $1,075,000 for the building and $90,000 for the machinery.
Which exceeds the threshold.
Yes, since this aggregate of $2,065,000 exceeds the $2,040,000 annual threshold, TDS is applicable. Tax would be deducted at 10% on the $1,075,000 building rent.
10%.
And at 2% on the $90,000 machinery hire charges.
2%. Got it.
This example shows how different rates can apply within the same section when the aggregate rent crosses the overall threshold.
Next, Section 194-IA. Payment on transfer of certain immovable property, other than agricultural land. This is directly relevant for property transactions. Who needs to deduct tax here?
Every transferee, the buyer responsible for paying consideration for the transfer of immovable property, land, other than rural agricultural land or any building part of building, to a resident transferor must deduct tax.
So the buyer deducts. What's the rate and the base amount? Is it just the sale price?
The rate is 1%. And here's a crucial point. The base for deduction is the higher of the actual sum paid as consideration or the stamp duty value of such property.
Higher of sale price or stamp value? Critical.
Absolutely. That higher of rule is key.
How is agricultural land specifically defined for this section? Given that rural agricultural land is excluded, does it mean urban agricultural land is included?
Yes, precisely. For this section, only rural agricultural land is excluded. The transfer of urban agricultural land will attract TDS under Section 194IA if the consideration or stamp duty value is 50 lakhs or more.
Okay. What if there are multiple buyers or sellers?
If there's more than one transfer or transferee, the consideration for TDS purposes is the aggregate consideration for the entire property, not individual shares. Tax is deducted at the earlier of credit to the transferor's account or actual payment.
And what's the threshold for non-applicability here, for smaller property transactions?
Correct. No TDS is required if both the consideration for transfer and the stamp duty value of the property are less than 50 lakhs. If either is 50 lakhs or more, TDS applies.
50 lakh threshold. Does it apply to compulsory acquisition by the government?
No, it does not. Compulsory acquisition is specifically covered under Section 194LA, so 194IA doesn't apply there. Importantly, the buyer is not required to obtain a tax deduction account number, or TAN, for this section, simplifying compliance for individuals.
Let's use illustration 12. Mr. X sells house property in Bangalore for 60 lakh, SDV 85 lakh, and rural agricultural land for 15 lakh, SDV 20 lakh, to Mr. Y, both residents. What are the TDS implications for Mr. Y, the buyer?
Okay. For the house property, both the consideration, 60 lakh, and the SDV, 85 lakh, are 50 lakh.
So TDS applies.
Yes. Mr. Y must deduct tax under 194IA. The base for TDS is the higher of the two, which is the SDV of 85 lakh. So the TDS amount is 1% of 85 lakh, 85,000.
85,000.
Right. Now, for the rural agricultural land, it is specifically excluded from 194-IA. Therefore, no TDS provisions are attracted for that part of the transaction. This highlights the rural-urban distinction and the higher of rule.
Next up, Section 194IB, payment of rent by certain individuals or Hindu undivided family. This is for individuals not covered by 194I because their turnover is low.
That's right. This applies to any individual or HUF who, because their turnover was below 1 crore business or 50 lakhs profession, is not required to deduct tax under Section 194II. If such an individual or HUF pays rent exceeding $50,000 per month to a resident, then Section 194IE applies.
Okay, rent over $50K a month, what's the rate here? And acknowledging the source's inconsistency, we'll use the section's stated rate of 5%.
Yes, the section text clearly states the rate is 5%. Tax is deducted only once in a financial year, which is a practical simplification. This deduction occurs at the time of credit or payment for the last month of the previous year, or the last month of tenancy if the property is vacated earlier, and no TAN is required for the individual deductor.
How is rent defined, and what's that critical restriction with Section 206AA if the landlord doesn't provide PAN?
Rent means any payment for the use of any land or building or both. The crucial restriction is that if the payee, landlord, doesn't provide PAN, tax is deductible at 20%, as per 206AA. However, here's the vital practical limit specific to 194 IB. This 20% deduction shall not exceed the amount of rent payable for the last month of the previous year or tenancy.
The last month's rent is the cap.
Exactly. This prevents an excessively large deduction from a single month's rent.
Let's walk through illustration 13. Mr. X, salaried, pays $55,000 month rent to Mr. Y from June 2024, using the source's solution values.
Right. Rent 50,000 months, so 194 IB applies. Normal scenario, not vacated. 10 months rent, 5,050,000. As per the solutions calculation, tax deducted is 11,000, computed as 55,000 by 2% by 10 months. Deducted from March 2025 rent. Noting the 2% used in the solution versus 5% in section text. Vacated Aug 31st, 2024. 3 months rent, 1,065,000. Here the solution uses 5%. TDS 8,250, 55,000 by 5% by 3 deducted from August 2024 rent, noting the inconsistency. If Mr. Y, landlord, no PAN, tax deductible at 20%. Case 1, not vacated. Calculated tax 1,010,000, 55K by 20% by 10. Restricted to 55,000 rent for March 2025 due to the cap. Case 2, vacated Aug 2024. Let's briefly cover Section 194 IC, payment under specified agreement, like a JDA.
This section applies specifically to payments under specified agreements, like joint development agreements. The rate of TDS is 10% on the sum paid. Tax is deducted at the earlier of credit or payment. It's concise, but important for these specific arrangements. Now, Section 194J. Fees for professional or technical services. A big one. Who's applicable and what are the rates?
Any person, excluding individuals, HUFs not subject to audit, paying sums for. Fees for professional services, fees for technical services, royalty, or non-compete fees must deduct tax. Rates vary. 2% for technical services, royalty, if not under 194.0, non-compete fees, and 10% for professional services.
2% or 10%.
Right. Deducted at earlier of credit or payment, deemed credit applies.
With the thresholds, same for all.
Yes, 30,000 for each category separately. So 30K for professional, 30K for technical, etc.
Are there specific non-applicability cases for individuals or HUFs under 194J?
Yes. Individuals or HUFs are not liable unless their turnover exceeded 1 crore business or 50 lakhs profession. And even then, they only deduct on professional or technical fees, not royalty or non-compete fees. Payments for personal purposes are always excluded.
A landmark case defining technical services under 194J is CIT v. Kotak Securities Ltd. What was the outcome?
The issue was whether transaction charges for online trading facilities were fees for technical services. The Supreme Court said no. Technical services implies specialized, customized services. The online trading facility is generic, automated, not specialized. So Section 194J was not attracted. This ruling significantly narrowed the scope of technical services.
What about acquiring software? Is there a provision to avoid double TDS?
Yes. No TDS under 194J or 195 if software acquired without modification. Tax was deducted on a previous transfer, and transferee gets a declaration from transfer confirming prior TDS deduction with PAN. This prevents multiple TDS on the same software.
Let's use illustration 15. East Bengal Club engaged Raghu as coach for 6 lakhs on him. Liable for TDS.
Yes. Coaching is a professional service. Payment, 6 lakhs, exceeds the 30,000 threshold. The club must deduct tax at 10% under Section 194J. Simple application.
Next, Section 194K. Income from units. What kind of units?
This applies to income from units of a mutual fund, specified under 1023D. Units from administrator of specified undertaking, like UTI, or units from a specified company subscribed by financial institutions, banks.
When is tax deducted? And any exceptions?
Deducted at earlier of credit or payment, deemed credit applies. Non-applicability if aggregate income is below 5,000. Crucially, this section does not apply if the income is capital gains.
5,000 threshold excludes capital gains. Got it. Moving on to Section 194LA, payment of compensation on acquisition of certain immovable property, specifically for compulsory acquisitions.
Precisely. Applies to person paying compensation or enhanced compensation for compulsory acquisition of any immovable property other than rural agricultural land to a resident. Rate is 10%.
When deducted, and what's the threshold?
Deducted at time of payment. No TDS if aggregate payments during the financial year do not exceed $2,050,000. Doesn't apply to rural agricultural land.
250,000 limit. Now, Section 194M. Payment of certain sums by individuals or HUF to catch large payments by those not covered by 194C, H, or J due to low turnover.
Exactly. Applies to individuals or HUFs whose turnover was below 1 crore business or 50 lakhs profession. If they make payments exceeding 50 lakhs in a financial year to a resident for contract work, commission or brokerage, or professional services, then 194M applies.
Okay, aggregate over 50 lakhs for those specific services. What are the rates and have they changed?
Yes, they've changed. Before October 1, 2024, the rate was 5%. On or after October 1, 2024, the rate is 2%. Deducted it earlier of credit or payment, no TAN required for the individual deductor. Definitions of work, professional services, commission refer back to L94C, J, H.
Let's use illustration 16, mixed scenarios. Mr. Ganesh, turnover 2.5 CR. Contract payment for personal use, 40K. Commission for business, 80K. Contract for personal use, 40K. No TDS under 194C, personal. No Serial 94M below 50 aggregate. Commission for business, 80K. Yes, under 194H at 5%. Ganesh's turnover 1 CR, payment 15K threshold. Mr. Rajesh, turnover 95 lakhs. Contract for factory, 70K. Professional fees for personal use, 35K. Contract for factory, 70K. Yes, under 194M at 2%, assuming after October 124. Rajesh's turnover 1 CR, so no 194C. If 70K payment makes aggregate 50L, 194M triggers. Illustration implies it does. Professional fees personal, 35K. No 194J. Personal, no 194M below 50L aggregate. Alpha LTD, PVT LTD. Tech services fees, 40K. Rent for machinery, 2.5L. Tech services fees 40K, yes, 194L, check services fees 40K. Very useful illustration. Now, section 194N, cash withdrawal. Very relevant. Who deducts?
Applies to banking companies, cooperative societies in banking, or post offices. They deduct when paying cash withdrawal.
Rates and thresholds, especially for non-filers. Seems tiered.
Highly specific and crucial. Standard rule. Withdrawal 1 crore. TDS at 2% on amount exceeding 1 crore. For non-filers, no ITR for all 3 preceding years with expired due dates. For non-filers, no ITR for all 3 preceding years with expired due dates. Withdrawal 20 lakhs, but 1 crore. TDS at 2% on amount exceeding 20 lakhs. For non-filers, no ITR for all 3 preceding years with expired due dates. Withdrawal 1 crore. TDS at 5% on amount exceeding 1 crore.
Lower threshold and higher rate for non-filers over 1 crore. Big incentive to file. Any exemptions for 194N?
Yes. Notified exemptions include GOFT entities, banks, post offices, WLA TMOs, APMC agents with conditions, CRAS franchise agents of WLA TMOs with conditions, authorized dealers, FFMCs, with conditions for specific FX transactions.
How is credit given for 194N TDS?
Credit given to the person from whose account tax is deducted for the relevant AY, Rule 37BA3A. Particulars must still be reported even if exempt.
Let's use the example table. Mr. Harshit filed ITR, withdraws 1.1 CR. TDS.
Standard rule. Exceeds 1 CR by 10 lakh. TDS equals 2% of 10 lakh equals 20,000.
Mr. Piyush, non-filer 3 years, withdraws 30 lakh.
TDS.
Non-filer. Exceeds 20 lakh by 10 lakh. Below 1 CR, TDS, 2% of 10 lakh equals 20,000.
Mr. Rohan, non-filer 3 years, withdraws 1.2 CR. TDS.
Non-filer exceeds both thresholds. Amount over 20L up to 1 CR equals 80 lakh. TDS at 2% plus 1,060,000. Amount over 1 CR equals 20 lakh. TDS at 5% once 1,000,000. Total TDS equals 1,060,000 plus 1,000,000 equals 2,060,000.
Clearly shows the tiers. Moving to section 194 out of O. E-commerce operator. Who deducts?
Every e-commerce operator deducts tax from the gross amount of sale of goods provision of services facilitated by it to an e-commerce participant. Rate is 1%.
When deducted. And what about direct payments?
Deducted at earlier of credit to participant is deemed paid by the operator and included in gross amount for TDS.
Exemptions, especially for small participants.
Yes. Small turnover. No TDS if participant is individual HUF and gross amount 5 lakh and Panadhar furnished. Exchanges. Not applicable to securities commodities on recognized exchanges or electricity energy certificates on power exchanges. Overlap priority. If tax deductible under any other provision, 194.0 shall not apply. Other sections take priority.
CBDT guidelines clarified many practical points. Payment gateways.
If ECO deducts under 194.0, payment gateway doesn't need to deduct again. Can take undertaking.
Insurance agents aggregators.
E-commerce operators not required to deduct tax under 194.0 on insurance product services.
Online food delivery hotel accommodation.
Generally, 194.0 doesn't apply if invoice issued by restaurant hotel directly to customer, even if payment via platform. Does apply if platform issues invoice or collects payment in its own account.
Online travel aggregators, OTAs.
If OTA issues invoice and airline hotel name and collects payment, 194.0 applies. If airline hotel issues invoice directly and OTA only gets commission, 194.0 doesn't apply.
E-auctioneers.
If only providing platform doesn't own goods, payment direct buyer seller, other conditions met, then 194.0 does not apply.
Multiple EKOs, buyer side, seller side. Who deducts?
The seller-side ECO who finally makes deemed payment to seller is responsible.
Gross amount definition. Includes extra charges.
Yes, includes additional charges collected by seller from buyer, packing, shipping, convenience, platform fees that are part of the transaction payment. TDS on the full amount.
GST adjustments.
If GST is separately indicated, TDS on amount without these taxes. If deducted on payment basis before credit, TDS on whole amount.
Operator discounts.
If operator gives discount but invoice is full price and operator recoups from seller, TDS is on the gross amount, full price.
Who is person responsible for paying for 194.0?
The e-commerce operator is deemed the person responsible.
Very detailed section.
Yeah.
Now, Section 194P. Deduction by specified bank for specified senior citizen. A simplification measure.
Yes. Applies to a specified bank notified for a specified senior citizen.
Definition of specified senior citizen.
Individual, resident, 75 plus years old, only income is pension and interest from the same specified bank and furnishes declaration, Form 12 BBA.
Bank handles their tax.
Exactly. Bank computes total income after Chapter VAA deduction, Section 87A rebate, and deducts tax based on rates in force.
Even applies default regime if not opted out.
Yes, if deductee hasn't opted out, bank deducts as per 115 BAC 1A, subject to conditions.
So they don't need to file ITR.
Correct. If bank fully deducts under 194P, the specified senior citizen is not required to furnish ITR under Section 139. Declaration is Form 12 BBA, paper form.
Let's use illustration 17. Mr. Sharma, 76, resident, pension plus FD interest, 5.1 Leo from SBI, ADD premium 50K, using source solution figures.
Okay, source solution shows total income 10,010,000 and pension 6 LSTD 50K plus interest 5.1 LAD 50K. It states default regime, Home 15 BAC, is beneficial, resulting in tax payable 63,960 inclusive of cess. Acknowledging the source's alternative calculation resulting in 26,940, we proceed with the steps leading to 63,960 as per text.
TDS by SBI and ITR filing.
SBI is specified bank. Mr. Sharma meets criteria. SBI deducts tax under 194P. Mr. Sharma is not required to file ITR.
What if FD was with Canara Bank, not SBI?
Then income isn't solely from the same bank. Mr. Sharma would not qualify as specified senior citizen. He would be required to file ITR under 139.
Crucial condition there. Now, Section 194Q. TDS on purchase of goods. Buyer deducts. Who is the buyer?
A person whose turnover exceeds 10 crore in the preceding FY, only large buyers.
Condition for TDS and rate.
Pays consideration for purchase of goods, value aggregate 50 lakh in a PY to a resident seller. Rate 0.1% on purchase consideration exceeding 50 lakh. Deducted at earlier of credit or payment, deemed credit applies.
Crucial priority rules. When does 194Q not apply?
Not required if 1. Tax deductible under any other provision, TLG 194CJ. Priority to other TDS. 2. Tax collectible under 2/6C except 206C1H, sale of goods 50L. So 194Q 206C1H.
TBDT guidelines 484Q, transactions on exchanges.
Not applicable to securities commodities on recognized exchanges or electricity energy certificates on power exchanges. Turnover calculation, purchase returns.
Turnover includes all sales receipts, goods, services, capital assets. For returns, tax can be adjusted against next purchase or refunded by debt.
GST component, advance payment.
If GST separate, TDS on amount without GST. Advance payment triggers TDS. Adjust later with invoice.
Buyer not in business. GOF debt, fuel to non-resident airlines.
GOF debt not carrying business is not a buyer. No 194Q. PSU scores are covered if turnover high. 194Q not applicable on fuel to non-resident airlines at Indian airports.
Summarize the complex hierarchy again. 194O, 206C1H, 194Q.
Okay, the priority order is key. 194.0 e-commerce TDS takes precedence over 194Q. If 194.0 applies, 194Q doesn't. 194.0 also takes precedence over 206C1H, seller TCS. If 194.0 applies, 206C1H doesn't. If 206C1H was collected before 194Q could be deducted, then no 194Q again. Prevents double deduction collection.
Very clear. Now, Section 194R, TDS on benefit or perquisite in business profession. Relatively new.
Yes. Applies to any person providing a benefit perquisite, cash kind, convertible or not, to a resident, arising from their business profession. Deductor ensures tax deducted before providing benefit. Rate, 10% of value.
Who is person responsible?
Person actually providing benefit. Company itself, including principal officer.
Benefit wholly in kind. How to ensure tax paid?
Provider must ensure tax paid before release. Recipient pays, example, advance tax, or provider deducts from other cash payments if possible.
Threshold.
No TDS if aggregate value equals 20,000 in FY.
Non-applicability for individuals HUS.
Yes, if their turnover does not exceed 1 crore business, or 50 lakhs profession in preceding FY.
CBDT guidelines, Circular 18/2022, are extensive. Deductor needs to check taxability for recipient.
No.
Yeah.
Crucial point. Unlike Section 195, deductor under 194R does not need to check taxability for recipient or under which section. Just deduct 10% if conditions met.
Benefit only in kind.
No, applies to cash, kind, or partly cash kind.
Capital asset as benefit. Car land.
Yes, TDS under 194R still required. Deductor doesn't assess final taxability for recipient.
Loan settlement waivers by banks, subject to 194R.
CBDT clarified. One-time loan settlements waivers by specified financial institutions, banks, NBFCs, ARCs, etc., are not subject to TDS under 194R. Relief for institutions. Taxability for recipient remains unaffected.
Sales discounts, rebates versus incentive samples.
Sales discounts rebates offered to customers, not benefits for 194R, usually adjusted against sales price. Free samples, yes, medicines to doctors, are benefits subject to 194R. Relaxation doesn't extend to samples. Other examples, incentive trips, cars, free tickets.
Benefit to employee of recipient, 4G doctor and hospital.
PDS deducted by provider in hands of hospital, recipient entity. Hospital may treat as perquisite for employee, Sec 17, and deduct under 192. For consultants, provider can deduct directly with consultant as recipient, practical relief. Gov entity not carrying business profession is exempt.
Valuation of benefit.
Fair market value, FMV. Exceptions. If provider purchased item, use purchase price. If provider manufactured item, use price charged to its customers.
Reimbursement of out-of-pocket expenses.
Depends on invoice name. Recipient's name. Not a benefit, their expense. Not recipient's name. A is a benefit provided by provider. Pure agent exception applies. If already part of consideration taxed under another section, for example 194J, no further 194R TDS.
Leave their conferences.
Primarily for educated dealers.
Yeah.
Generally not a benefit. Exceptions. RE benefits. Leisure component, family members' expenses, expenditure on non-conference days.
Practical difficulty for group activities.
Provider has option. Choose not to claim the expenses deductible. If they do this, not required to deduct tax under 194R. Significant relief.
How to ensure tax paid for in-kind benefit.
Recipient provides proof.
Sure.
Form 26Q reporting. Alternative. Provider deducts tax itself, pays GOBA. Tax paid by provider is also a benefit under 194R, reported in Form 26Q.
Bonus rate shares.
Tax under 194 not required for bonus right shares issued by widely held company to all shareholders proportionally.
Very detailed. Quick note on non-applicability for corporations exempt under 1026BBB.
Yes, Circular 7/2015 extended non-TDS benefit from Circular 42,002 to corporations for ex-servicemen welfare exempt under 1026BBB, as their income is exempt.
Income payable net of tax, Sec 195A.
If payer agrees to bear tax, income must be grossed up for TDS calculation. Payer still issues TDS certificate, crucial for international deals.
Broad exemptions for payments to Gov, RBI, certain corporations, Sec 196.
Yes, no TDS on payments to Gov, RBI, Central Act corporations exempt from tax, mutual funds, 1023. Fundamental exemptions.
Quick summary of other key TDS sections and rates.
Okay, briefly, 194 LBB investment fund to unit holder. Res. Indi issue F 25%, others 30%. NR rates in force. 194 LBC securitization trust income. Res Indi issue F 25%, others 30%. NR rates in force. 194 LC interest by Indian Co-Biz Trust to NR non-corp foreign co. Varies. 5% certain loans, 4% Masal bonds, 9% IFSC listed bonds post 1.7.23. Nil for some older bonds exempt as 10-4C. 194S virtual digital asset transfer, 1%. More in digital tax chapter, 195 other sum to non-resident. Rates in force, Finance Act DTAA. More in NR tax chapter. 196A income on MF unit specified co-units to NR non-corp foreign co, 20% or DTAA rate if TRC. 196B income LTCG on MF UTI units in foreign currency. Income LTCG pre 23.7.24, 10%. LTCG on after 23.7.24, 12.5%. 196E income of FIIs from securities not cap gains, 20%. DTA rate if lower plus TRC. Specified fund income, 10%.
For NR non-core foreign currencies, rates increase by surcharge plus 4% HEC.
Okay, comprehensive list, hashtag 3. Certificates for lower no TDS and exempt cases. Let's talk certificates for lower and no TDS and exempt cases. Section 197 allows applying for lower nil TDS.
Yes, for many sections 192, 193, 194, 194A, C, D, G, H, I, J, K, LA, LBB, LBC, MO 195, a person can apply to the AO for a certificate.
And a recent addition.
Yes, from October 1, 2024, Section 194Q, purchase of goods, is included, allows buyers to apply too. One certificate issued, payer must deduct at that rate or nil until canceled.
Section 197A, No deduction via declaration for low-income individuals.
Right. Two main parts. Subsection 1. Resident individual income basic exemption can declare Form 15G for no TDS on dividends 194 and NSS payments 194E. Must state tax will be nil. Subsection 1A. Any person, not company firm, can declare Form 15G 15H for no TDS on 192A, 193, 194A, 194DA, 194I, 194K if tax on total income is nil.
Restriction if income exceeds basic exemption.
Generally, yes. Subsection 1B. Except for resident senior citizens using Form 15H. They can file 15H even if income basic limit, provided their net tax liability is nil after deductions rebate 87A. Avoids unnecessary TDS refunds.
Compliance duties and consequences. Section 1T9 Rule 37BA. Credit for TDS.
Credit given to deductee based on deductor's info. Rule 37BA2 allows credit to another person if income accessible in their hands with declaration. For 194N, cash withdrawal, credit to person whose account deducted from Rule 37BA3A. TCS credit for lease license spread over years income assessed.
Duties of deductor. Section 200.
Three main duties. 1. Deposit tax to GoFrag. 2. Furnish statements quarterly. 3. Furnish certificates, Form 1616A, etc., to payee. Can furnish correction statements.
New time limit for correction statements. WF 1.4 to 2025.
Yes, significant. Cannot submit correction statement after 6 years from end of FY of original statement. Introduces finality.
Consequences of failure. Section 201. SSE in default.
Failure to deduct or deduct and not pay deemed assessee in default triggers liabilities.
Relief if payee pays tax.
Yes. Proviso to 201. Deductor non-default if pay files return, includes income, pays tax, and payer furnishes accountant certificate. Lifeline for deductors. No penalty is 201 unless failure without good reason.
Interest liability. Section 201(1)A.
Crucial. Yes. Mandatory interest. Failure to deduct. 1% PM part on tax. From date deductible to date deducted. Failure to pay after deduction. 1.5 per PM part on tax from date deducted to date paid.
Example. Fail to deduct 4K for 8 mil. Fail to deposit 9K for 4 mil.
Interest, 4,000 by 1% by 8 plus 9,000 by 1.5% by 4 equals 320 plus 540 equals 860. Interest paid before furnishing statement.
If payer not in default, paid tax. Interest still payable by payer.
Yes. Interest at 1 per TM for failure to deduct, still payable by payer from date deductible to date pay filed return. Payer still liable for initial failure. Unpaid tax plus interest becomes charge on assets.
Can this interest be waived? Circular 11-2017.
Yes. PRCCITDGIT can waive reduce for genuine hardship. Conditions. Assessee must file ITR, pay tax, cooperate, no similar default in 5 years, demonstrate hardship, or default due to retrospective law-binding court decision.
Siemens Ltd. case on genuine hardship.
Supreme Court. Merely disputing demand is not enough. Interest mandatory. Genuine hardship requires concrete proof of severe financial distress. High bar.
Section 203. TDS certificate obligation.
Deductor must issue certificate, Form 1616A, etc., stating amount, rate, etc. Employer paying tax on non-monetary perks, 192(a) issues specific certificate.
Key deadlines for remittance statement certificates.
Critical dates. Remittance, Government, same day, 7 days. Others, generally 7 days from month end, April 30 for March, sections 194I, AIB, MS, 30 days from month end, statements quarterly, Q1, July 31, Q2, October 31, Q3, Jan 31, Q4, special forms 26, QBCDE, 30 days from month end, certificates Form 16, salary 194P, June 15, Form 16A, others, 15 days from quarterly statement due date, Form 16 BCDE, 15 days from child income statement due date.
Section 203A. TAN requirement.
Deductors collectors must get tax deduction and collection account number TAN, quote, in challenge certificates, statements, penalty, 10K is SUPB for failure or false TAN. CBDT can exempt some.
Section 204 defines person responsible.
Yes, PIN's accountability. Payer, employer, company, principal officer, agent for NR.
Section 205. Bar against direct demand on assessee. Key protection.
Crucial. Where tax is deductible, assessee cannot be asked to pay it to extent tax deducted. If deductor fails to deposit recoveries from deductor.
SGD format case confirmed this.
Yes. Delhi HC. Section 205 bars recovery from deductee if tax was deductible. Recovery against defaulting deductor, a GOF's agent. Significant protection.
Section 206. Annual TDS TCS statements.
Deductors collectors must prepare deliver periodic statements. Failure penalty 500 day, Section 271H.
Section 206AA. Mandatory PAN furnishing. Impact.
If deductee no PAN, TDS at higher of 2x prescribed rate, 2x rate in force, or 20%. Invalid PAN. No PAN, no 15GH or 197 cert without PAN. Both must quote PAN.
Relaxation for non-corporate NRS foreign costs without PAN.
Yes, for specific payments, Interest, royalty, FTS, dividend cap, asset transfer. Exempt from 206AA, higher rate if furnished specific alternative details. Name, email, contact, address, residency cert, TIN.
Air India case. 206AA versus DTAA.
Supreme Court. 206AA cannot override beneficial DTAA provisions if NR has no PE in India and thus not required to have PAN. DTAA rate applies even without PAN. Treaty override upheld.
Section 206AB. Higher TDS for non-filers.
Yes, tax deducted from specified person at higher of 2x prescribed rate, 2x rate in fours, or 5%.
Exceptions where 206AB not applicable. Crucial list.
Not applicable for TDS under.
Yep.
192 salary, 192A EPF, 194B lottery, 194BA online games, 194BB horse race, 194IA property, 194IB rent in HUF, 194LBC securitization, 194M sums in HUF, 194N cash withdrawal. Normal rates apply here even for non-filers.
Interaction 206AB no PAN versus 206AB non-filer.
If both apply, TDS at higher of the rates from 206AA and 206AB.
Who is specified person for 206AB?
Person who 1. Has not filed ITR for preceding AY, due date expired, and 2. Aggregate TDS TCS was 50K or more in that PY. Targets significant non-filers, excludes. NR without PE, notified persons like RBI, ###SHAP5. Tax collection at source, TCS of certain goods. Sellers collect from buyers at specified rates. Alcoholic liquor, human consumption, 1%. Tendu leaves, 5%. Timber, forest lease, 2.5%. Timber, other mode, 2.5%. Other forest produce, 2.5%. Scrap, 1%. Minerals, coal, lignite, iron ore, 1%.
Non-applicability if buyer uses for manufacturing. Sect 206C1A.
Yes, if resident buyer declares goods for manufacturing processing power generation, not trading. Collector delivers the declaration copy to CIT.
Definition of buyer here. Exclusions.
Person obtaining goods. Excludes. PSUs, Gov, embassies, clubs, buyers and retail sale for personal consumption.
Priya Blue Industries case. Finished products from shipbreaking, scrap.
Gujarat HC. No, scrap useless remnants, usable finished goods, old plates, wood, are not scrap under 206C. No TCS on their sale.
Section 206C1C. Lease license for parking lot, toll plaza, mine, quarry.
Person granting lease license, not PSU, collects tax. Rate, 2%. Excludes mining, quarrying of mineral oil, petroleum, natural gas.
Section 206C1F. Sale of motor vehicle, 10 lakhs.
Seller receives consideration for motor vehicle sale, 10 lakh, collects TCS. Rate, 1% of sale consideration.
CBDT Q&A clarifications. Retail level or manufacturer dealer.
Primarily retail sales, not applicable manufacturer to dealer distributor.
Only luxury cars. Sale to Gulf embassies.
No, any motor vehicle, 10L Goved, UN institutions, embassies exempt.
Each sale or aggregate. Applicable to individual seller. Payment mode matters.
Applies to each sale 10L, not aggregate. Yes, applies to individual sellers. Payment mode irrelevant.
Section 206C 1G.
What?
LRS remittance and overseas tour package. Very topical.
Authorized dealer, LRS, or seller, tour package, collects from buyer, time, earlier of debit or receipt.
Rates. Specific thresholds and purposes. Changed recently.
Critical rates, education not loan, medical, up to 7L nil. Above 7L, 5% on excess. Education loan and SADE, up to 7L nil, up to 7L, up to 7L. Up to 7L, 20% applies from first rupee. Other LRS remittances, up to 7L nil, above 7L, 20% on excess.
CBDT guidelines, Circular 1L 2023. Overseas credit card payments.
Use of international credit cards while overseas. Classification as LRS postponed. No TCS until further order. Major relief.
7 lakh LRS threshold. Combined or separate for purposes.
Combined threshold for LRS applicability, irrespective of purpose. First, 7L total exempt, then applicable rates on excess.
Threshold per remitter or per dealer.
Qua remitter, per person. Total remittances across all dealers considered. Dealers may take undertakings.
LRS threshold versus tour package threshold independent.
Yes, independent. LRS threshold applicability, no below 7. Tour package threshold, rate 5% or 20%. TCS applies regardless of amount.
Small tour package, 3 lakh.
TCS applies under tour package rules. Amount 7L, so TCS at 5%.
Scope of medical treatment education.
Defined by RBI purpose codes. Health services travel for education, including tickets, fees, living expenses.
Definition of overseas tour program package.
Must include at least 2 of international travel ticket, hotel boarding lodging, other related expenditure. Buying only ticket or only hotel is not a package.
Cases where no TCS under 206C1G.
No TCS by dealer if seller already collected. Tour package. No TCS if buyer liable for TDS and deducted tax. No TCS if buyer is Goved embassy, local authority, or notified person, e.g. NR without PE in India. Non-FN 992022.
Section 206C1H. Sale of goods, 50 lakhs. TCS counterpart to 194Q.
Seller receives consideration for sale of goods. Aggregate value to buyer 50 lakhs in PY. Excludes. Exports goods under 206C 1F1G. Rate, 0.1% on sale consideration exceeding 50 lakhs. Time, at receipt of consideration.
Not applicability. Priority rule.
Not applicable if buyer liable for TDS under any other provision and has deducted tax. This gives priority to TDS.
Definition of seller. Large sellers only.
Yes, seller whose turnover 10 crore and preceding FY. Buyer excludes GOVT, embassies, etc.
CBDT guidelines for 206C1H. Exchanges. Sales to dealer versus consumer. Fuel to non-res airlines.
Not applicable in recognized exchanges. Applies to receipts from dealers if not under 1F. Applies to consumer sales. e.g. cars equal 10L if aggregate 50L. Not applicable on fuel to non-resident airlines at Indian airports.
Reiterate cross-application rules. 194.0, 206C1A, 2094Q one last time. Crucial hierarchy.
Final time. 194.0, 194Q, 194.0, 206C1H. 194Q, 206C1H. Practical concession. If 206C1H collected before Con 94Q deducted, no double deduction.
Section 206C1A, non-furnishing pan by collect D, higher rate.
Yes, mirrors 206CBRA. If collect D, no pan. TCS at higher of 2x prescribed rate or 5%. Invalid pan, no pan, not applicable to NR without PE.
Section 206CCA, higher TCS for non-filers.
Mirrors 206AB. TCS from specified person at higher of 2x prescribed rate, 2x rate in force, or 5%. If both 206CC and 206CCA apply, TCS at higher of the two rates. Specified person definition, same as 206AB, non-filer plus TDS TCS 50K. Exclusion same. NR without PE. Notified persons like RBI.
Let's use the Gupta-Garwal example again quickly for pan impact. If pan, not furnished. 194Q, Gupta deducts, Agarwal no pan. Gupta deducts at 5%, higher of 2.1% or 5%. 206C1 Agrawal collects, Gupta no pan. Agarwal collects at 1%, higher of 2.1% and 5%. Wait, 206CC rate is 5%, so it should be 5%, not 1%. Checking, yes. 206CC rate is higher of 2x rate OR 5%, so it should be 5%. Let me correct that. Agarwal collects at 5%. Okay, 5% under 206CC if no pan. Good catch. Time limits for TCS payment statement certificates, similar to TDS.
Yes, analogous. Form 27EQ statement. Form 27D certificate.
Credit for TCS Sec 206C4.
Deemed payment for collect D. Credit for relevant AY can be given to other person if income accessible there, W16.0.24 with declaration.
Certificate Sec 206C5.
Collector issues Form 27D within 15 days from quarterly statement due date.
Consequences of failure to collect TCS.
Personal liability 206C6. Collector liable to pay, even if not collected, interest 206C7 WEF 1.4.25. Fail to collect 1 per CCM. Fail to pay after collecting 1.5 per CM. No double interest with 222.
Certificate for lower TCS Sec 206C.
Yes, buyer lessee applies to AO. Includes 206C1H from October 1, 2024. Collector follows certificate. A GOV can also notify exemptions lower rates. Sec 206C12 WEF 1.006CEP. Processing of TDS, TCS statements, Section 200A, Section 206CB.
Processing TDS TCS statements Sec 2000A 206CB. Purpose.
Expedite processing via automated system. Determine tax refund quickly.
How does it work? Adjustments allowed.
Imputes sums deductible collectible. Adjusts for arithmetical errors, incorrect claims apparent from records, interest fee. Determines sum payable air fund due. Intimation sent. Refund granted.
Time limit for intimation.
1 year from end of FY statement filed. Provides finality. CBDT can make schemes for centralized processing.
Wider ambit for 200A, WP 1.4.25.
Yes, CBDT can make scheme for processing statements by any other person, not just deductor. Agile Form 26QF by exchange. Broadens automation. Hashtag TAG77. Advanced payment of tax sections 207 to 219.
Advanced tax Sec 207-219. Principal, pay as you earn.
Precisely. Tax payable in advance during FY on current income, chargeable next AY.
Threshold, 10K.
Yes, obligation if advanced tax payable equals 10,000. Below that, no interest us 234 BC, but maybe 234A.
Exemption for senior citizens, Sec 207-2.
Yes, significant relief. Resident senior citizen 60 plus. Without business profession, income is not liable for advanced tax.
Computation, self-assessment usually.
Yes, assessee estimates income, pays tax. No need to submit estimate unless AO issues notice. Do 10.3.
Crucial rule. Impact of TDS not deducted on advanced tax.
Yes, addresses past issue. Proviso to Sec 209. Tax deductible but not deducted by payer shall not be reduced from pays tax liability for advanced tax calculation. Only actually deducted TDS reduces advanced tax liability. Same for TCS. Ensures assessee accounts for tax that should have been withheld.
Agricultural income considered.
Yes, net agricultural income considered for rate purposes.
Installments and due dates, key table.
Critical dates. All assessees, except presumptive. June 15%, Sep 15, 45% less paid. December 15th, 75% less paid. Mar 15, 100% less paid. Presumptive, 44 data. Whole amount in one installment by Mar 15. Presumptive, 44 data. Any payment by Mar 31 counts for that FY. AO demand notice has own deadlines. Presumptive, 44 data. Hashtag tag hate. Levy of interest sections 234A, 234B, 234C, and 234D.
Levy of interest. Penalties for defaults. Section 234A. Default in furnishing ITR.
Fails to file by 139, due date. Rate, 1% simple interest PM part period. Due date to date filed or assessment completion if not filed. Amount, tax on total income, as assessed minus advance tax, TDS TCS reliefs, 899090A, tax credits 115 JAAJD.
Clarification. Circular 234A. Interest on self-assessment tax paid by due date.
No, based on Pernori Roy case, default in paying advance tax. Applies if no advance tax paid or paid 90% of assessed tax. Rate, 1% simple interest PM part period. April 1 of AY to date income determined. Amount on assessed tax if none paid or shortfall if 90% paid. Assessed tax on total income minus TDS TCS reliefs credits. Reassessment 234B3. Interest on increase in tax from April 1 following FY to reassessment date.
Section 234C. Deferment of advance tax. Missing quarterly deadlines.
Applies if installment specified percent. Rate, 1% simple interest PM part. Calculation, June 15 shortfall 15%. Interest 3 months. Sep 15 shortfall 45%. Interest 3 months. Mar 15 shortfall 100%. Interest 1 months. Concession. No interest of June 15 short percent or Sep 15 equals 36%. Income accruing later. Pay tax in remaining installments or by Mar 31. Note 234C interest on that specific income.
Section 234D. Interest on excess refund granted at 143.
Applies if 143 refund found excessive annuls later on regular assessment. Rate, 0.5% simple interest PM part period. Data 143 come on. Refund grant to data regular assessment. Recovers interest on wrongly refunded amount. Hashtag 9. Levy of fee sections 234E and 234H.
Levy of fee. Section 234E. Default in furnishing TDS TCS statements.
Fails to deliver statement on time. Fee, 200 per day of default. MAPS fee, cannot exceed amount of tax deductible collectible.
Mr. Madhusudan example, delay 52 days, TDS 80K.
Fee, 200 by 52, owes 10,400. Less than 80K, so fully applicable. Can apply for waiver S-119 for genuine hardship.
Section 234H. Fee for Panadhar linking default.
Applies if failed to link within prescribed time. Fee as prescribed, for example, 500, 1,000 after deadlines. Hashtag 10, collection and recovery of tax. Other methods.
Other recovery methods. Section 220. Payment of tax and defaults.
Demand notice amount due within 30 days. Default interest 222. 1% simple PM part from day after due date to payment date.
Waiver reduction of interest 222A.
Yes, PRComCom can waive reduce for genuine hardship. No double interest with 2A6C7.
Penalty. Section 221.
If assessee defaults payment, AO may impose penalty, max in tax and arrears, discretionary.
Tax Recovery Officer, TRO, Section 222. Powers.
AO sends certificate to TRO for arrears. TRO powers. Attack sale property, movably movable, appoint receiver, arrest detain assessee. Includes property transferred to relatives without adequate consideration.
TRO jurisdiction, Section 223.
Where assessee has business residence property, can send certificate to another TRO if property elsewhere.
Validity of TRO certificate, Section 224. Can assess dispute.
Assessee cannot dispute certificate correctness. TRO can cancel correct clerical errors.
Stay proceedings, Section 225.
TRO can grant time, stay recovery. If demand reduced an appeal, can stay pending further proceedings, subject to conditions.
Other modes of recovery, Section 226. AO powers.
AO can also recover via attached salary, garnishee proceedings, order debtor bank to pay gift, distraint sale of movable property, appoint receiver.
Recovery via foreign agreements, Section 228A.
Gov can agree with foreign countries for tax recovery. Foreign cert sent to TRO recovers as Indian tax arrear.
Tax clearance certificate, Section 230. For leaving India.
Non-domicile business prof-employ. Need undertaking from payer. No objection cert. Excludes tourists others. Domiciled. Furnish PAN. Authority can require certificate in specific cases. With reasons, senior approval. Owner charterer liable if allows departure without compliance.
Faceless collection and recovery, Section 231.
Clft can notify scheme for faceless operations. Scope, lower TDS TCS certs deeming default, advanced tax orders, interest waivers, time extension, penalty levy, TRO actions, stay, other recovery, tax clearance, features. No interface, resource optimization, team-based issuance.
Recovery by suit other law, Section 232.
AO not restricted to IT Act methods, can use other laws, file suit to recover tax debt. Hashtag tax 11.
Refunds and interest, eligibility.
Sec 237. Entitled If Tax, Pig Tax Properly Chargeable Due to Excess Tedious Advance Tax, Appeal Orders, etc.
Who claims refund, Sec 238.
Generally, person on whose account tax paid.
Time limit for claim, Sec 239.
Within 1 year from end of relevant AY.
Refund of TDSS 195, Sec 239A. If no tax was deductible.
Yes, person who deducted paid can apply to AO for refund. Time limit. 30 days from date of tax payment. AO passes order within 6 months.
Refund on appeal, Sec 240. Automatic.
Yes, if refund due from appeal revision order, AO bound to issue refund automatically. No separate application needed, unless fresh assessment directed.
Correctness of assessment question, Sec 242.
No, assessee cannot question final assessment correctness when claiming refund.
Interest on refund, Sec 244A. Rate, period.
Rate, 0.5% simple PM part, period varies.
Yeah.
From TCS advanced tax deemed pay if ITR timely, April 1 of AY to refund date. If ITR late, filing date to refund date. From self-assessment tax, later of filing date or payment date to refund date. Other cases, e.g. penalty refund, payment date to refund date.
Minimum refund for interest.
No interest if refund 10% of tax determined for TCS ADV tax self-assessed tax cases.
Additional interest, Sec 244A1A. Delay in appellate orders.
Yes, if refund from appeal revision delayed beyond specified period. Interest for delay period attributable to debt, exclusion, W.EF 1.0124, period refund withheld by AO excluded.
Interest on refund to deductor, 244A1B.
Yes, 0.5% PM if refund due to deductor for excess payment.
Yeah.
Resamp 195. Interest received on refund is taxable.
Prosecution for failure to pay TDS TCS, 276 ppb.
Yes, serious offense. CBDT guidelines, Circ 24/29/10. Prosecution generally not launched if amount 25 lakhs A&D delay 60 days. Exception, habitual default or serious cases needs collegium approval. Hashtag tag significant select cases. Crucial rulings affecting interpretation and application.
To wrap up, let's quickly highlight some significant court rulings that shape how these laws are applied. These cases are crucial.
Absolutely. They provide vital context and precedent.
ITC LTD v. CIT on tips as salary, Sec 192.
Supreme Court, no. Tips voluntary, employer acts as fiduciary, not salary profits in lieu, outside Sec 192.
Japan Airlines, Singapore Airlines on landing parking charges as rent, Sec 194I.
Supreme Court, no. Charges for bundle of services, land use incidental, not rent. Sec 194I doesn't apply.
Sahara India on stamp vendor discount as commission, Sec 194H.
Court, no. Vendors buy sell as principals, not agents. Trade discount, not commission.
Kotak Securities on online trading charges as tech services, Sec 194J.
Supreme Court, no. Facility generic, not specialized customized service, not fees for technical services.
UCO Bank on interest for Registrar General FTR, Sec 194A.
Sort, no TDS until court decides beneficiary, registrar not pay, CBDT accepted.
Indus Towers on passive infra charges, Sec 194C versus 194I.
Overwatch LEHC. Sec 194I applies. Dominant intention, use of equipment, plant, machinery, rate at 2%.
SBI case on co-owned property rent threshold, Sec 194I.
Allahabad HC. Threshold applies to each co-owner separately if shares definite.
Baruka Logistics on transport contractor payments, Sec 194C.
Court. Yes. Involves carrying out work. Sec 194C applies.
Vias Tempo on demurrage to foreign shipping clause, Sec 195 versus 172.
Court. No TDS 195. Sec 172. Shipping biz NR overrides via non-obstante.
Prosaparati on ad agency commission, Sec 194H.
Supreme Court. Yes. TDS applicable. Specific agreement established principal-agent relationship. Overrides general circulars based on facts.
Idea Cellular on telecom distributor discount, Sec 194H.
Supreme Court. No. Relationship principal to principal, not agency. Discount, not commission.
SGD Pharma on recovery from deductee if deductor defaults, Sec 205.
Delhi HC. No. Sec 205's bars direct demand on assessee if tax was deductible. Recovery against defaulting deductor.
Air India on 206 LAA versus DTAA.
Supreme Court. 206 LA does not override beneficial DTAA rate if NR has no PPAN requirement. Treaty prevails.
Siemens Ltd on waiver of interest as 220 2A.
Supreme Court. No waiver just for disputing demand. Genuine hardship must be proven, considering financial capacity. High bar.
Singapore Airlines KLM on supplementary commission for travel agents, Sec 194H. Penalty.
Supreme Court. Yes. TDS applicable on supplementary commission agency relationship. Penalty quashed. Reasonable cause due to conflicting rulings. Interest still applicable if tax unpaid. Hashtag tech outro.
What's really fascinating here, I think, is how these seemingly dry legal provisions underpin so much of our daily economic life.
It's true. From your salary withdrawal to that online game winning, even buying your car. Understanding the precise thresholds, the rates, and those all-important exceptions in court rulings can truly save you from unexpected tax liabilities and compliance headaches.
Absolutely. It's clear that the landscape of tax deduction and collection is incredibly detailed, with constant updates and new interpretations. From the precise conditions for a senior citizen to avoid filing a return, to the nuanced rules for e-commerce transactions, and even those high-stakes online game winnings, every single detail truly matters.
This exhaustive deep dive raises an important question, doesn't it? In an era of rapid digital transformation and evolving economic models, how quickly and effectively can tax laws adapt to capture new forms of income and ensure compliance while still balancing ease of doing business for legitimate transactions?
Yeah, that's the balancing act.
The constant clarifications, new sections, and landmark court rulings we've explored today show a persistent and often challenging effort to keep pace.
Indeed. And for you, our listener, the takeaway isn't just a list of rules and sections. It's an appreciation for the precision required in modern financial dealings and the importance of staying informed. This deep dive should arm you with the fundamental knowledge to approach tax matters with confidence, whether you're dealing with your employer, an online platform, a bank, or planning a major property transaction.
Remember, knowledge is most valuable when it's understood and applied. We've walked through the what and the why for each of these intricate provisions, examining not just the rules, but also the practical implications and the crucial legal interpretations.
Right.
Now it's over to you to consider the implications for your own financial world, question assumptions, and perhaps even spot areas where you can optimize your own compliance and avoid common pitfalls. We encourage you to revisit this deep dive whenever you encounter these situations, as these details are truly key.
Thank you for joining us on this incredibly detailed and comprehensive deep dive into mastering tax deduction, collection, and recovery. We hope it's given you that vital shortcut to being truly well-informed. Until next time, keep learning, keep questioning, and stay well-informed.